Welcome back to Primary Source China Investment. This week we're on show X6 and we're talking a little bit about the fixed income market and these rate cuts that happened this week. At the Lujiazui Forum in June, China's central banker Pan Gongsheng said Beijing would prefer to target the 7-day repo rate rather than the medium lending facility, the bank-to-bank rate, or the loan prime rate. This would link rates more closely to bond yields. So that's a great philosophy from a macro perspective. So this week, the PBOC issued 1-year medium lending facility notes at 2.3%, down 20 basis points from its previous MLF loan, its largest cut since April of 2020. 3 days prior to that, the bank cut the 7-day reverse repo rate to 1.7 from 1.8, and the lending prime rate by the same margin. The implication is to target the price of money instead of the money supply. And all of this should be viewed positively from a policy and macro perspective. The short-term implications for investors may be bumpy. So Penghua, on the policy side, what do you think the strategy is and how do you think that's going to play out?
Yes. China right now is already formed a market-driven rate, and in China that's three parts. First, they call like the central bank policy interest rate. You just mentioned 1-year medium lending facility rate. Another one is a 7 days reverse repo rate. So those they call the central bank policy interest rate. Another one they call the market base interest rate. This is DR007, LPR, and Treasury bond interest rate. So those three rate forms three market interest rate. So the major interest rate product are probably around the 10. So we can give the table so people can understand that is a major product in the market.
It really is getting into the weeds. There's a lot of rates, a lot of changes.
That's
and
right.
maybe just from a top-down perspective, let's just put the 10-year up and you can see the 10-year has been dropping for 18 months or so. So we've gone from 290 to 219, and that's a massive drop. So you're seeing the short-term rates being pulled down as well. You have a positive but flattening yield curve. The corollary to this is the renminbi, right? If you're from a US perspective, US dollar perspective, the corollary is renminbi depreciation. And that's been 15% since April of 2022, which probably goes a long way to explaining why foreign brands are struggling, geopolitics notwithstanding. You can see renminbi is now 725. So this FX depreciation and rate drop explains CBON, really the only fixed income ETF for China that we have. Remember, this is priced in US dollars. So while rates were declining and CBON price was probably increasing, but renminbi was depreciating, fighting against this. So the net is that CBON's price was flattish, although they had some volatility. You can see the chart, and it's just under 3% yield. Let's compare that to AGG, which in the US, which represents the aggregate bond market of the US, includes some corporates and some govies, and that's at about 344. So for a foreign investor looking at China, they say, I get 3% with CBON, or I get 344 with AGG. It's pretty easy. But generally speaking, cutting rates should be stimulative, cheaper money, et cetera. The counter argument to this is that the high savings rate in China and how cutting short-term rates eats into returns for investors. So demand deposit rates were already abysmal in China and were cut again. ICBC, a huge bank, cut demand deposit rates from 20 bips to 15 and 1-year deposits from 1.45 to 1.35. Investors are staring at a very low yield environment. Will that stimulate them to do something else? What do you think?
I think right now it's due to the real estate market crash. Most of the people have no confidence for the risk market. So you probably to see the A-share market is still low, and that's really a struggle for that. So that means that most of the money is sitting in the bank. They push to the bond market. This is really like the market react to the entire the economy. Even like the central bank, they cut the rate. I think a few days ago, but the Asia market is still not get up. So liquidity, I think, in the market should be okay, but really people have no interest to do the investment, and also it's hard to find the good product to invest it. So
Yeah.
the money just sit in the bond market. That's it.
There's another chart that I saw this week which showed how much mortgage loans are being paid off. And I'll just throw that up there very quickly. So this shows existing mortgage loans and the annual change in loans outstanding. So you can see there's a huge drop off in loans outstanding. So people are maybe taking their savings and paying off higher yielding debt because, right, if rates are coming down, you're able to refinance at a lower price, maybe take some debt off the table. I mean, it's smart financially. It's not stimulative as what Beijing wants. You want to cut rates and you want to stimulate consumption. It doesn't necessarily look like that's going to be the case. So we're going to leave it there with show X6, a little bit about fixed income. Thanks for tuning in, and we'll see you next week.
Thank you.